Accounting periods and methods. We're looking here at what the tax year is and how it is they're going to determine when something is either taxable or deductible. We start with the tax year. The tax year can either be a calendar year or any other fiscal year. When you file your first return, you're making that decision. But in order to use a tax period other than a calendar year, the taxpayer needs to be able to keep accurate books and records because they're going to have to be able to demonstrate that that tax year is actually what's happening and how it is that they're accounting for it. For married taxpayers to be able to file jointly, both of those taxpayers need to have the same tax year. Now, how we determine what is included? Well, we have the cash method and the accrual method. Usually tax calculations are made on a cash basis of accounting, and under the cash basis, the taxpayer recognizes an income, any income that is either actually received or constructively received during the tax year, and it's this constructively received that's most important. There's different ways that we can have constructive receipt. So even though we don't have the money, we are still going to be considered to have received it. So garnished wages are considered to have been received. Debt canceled or paid for a taxpayer, but not as a gift or a loan, is considered to have been received. Income payments paid directly to a third party from property owned by a taxpayer. Well, that's considered to have been received by the taxpayer and then paid to the third party. Income paid in advance, it's includable in our gross income for the year that we received it, and then also checks that we received and are available to the taxpayer without restriction. But if we have that check and there are restrictions connected to it, it is not going to consider to have been constructively received. And we have an example about that. Jill is a cash basis taxpayer. To earn extra money, she works as a photographer in the month of December. Jill shot a family portrait for the Johnson family on December 15th, 2020, and receives a check for her work on that date. The Johnsons dated the check January 2nd, 2021, and asked Jill not to cash it until that time. Well, in this situation, Jill does not recognize this as income in 2020 because of the restriction on being able to cash that check and get the money withdrawn out of the account. And so we don't have constructive receipt in this case. Now, in addition to the cash method, there's also the accrual method. And under the accrual method, a taxpayer generally reports income in the tax year that they earn it, regardless of when the payment is received. And similarly, the taxpayer deducts expenses in the tax year that they incur them, regardless of when payment is made. And the IRS considers the taxpayer to have earned the income when all of the events have occurred that fix the right to receive that income, and the amount can be determined with reasonable accuracy. Now, C corporations, taxpayers with inventories, and tax shelter entities generally must use the accrual method for their accounting purposes for their tax return and making all of those tax calculations.